Here's a complete analysis of the unemployment data that came out and why it should matter for you. There were 256,000 jobs added in December, far greater than the 155,000 that was expected. This is great, kinda. The unemployment rate reduced from 4.2% to 4.1%, which is also amazing, kinda. Also, the hourly rate increased by 0.3, which is fantastic. Kinda. And this is why the kinda comes in. See, employment rising by that amount, and unemployment reducing, and wage increasing on those levels points to a few negative things, especially for risk on assets. This report briefly pushed the 10-year Treasury bonds to over 5%, which is insane and also extremely bad for risk on assets, because that means that inflation is in the future. And inflation in the future means that there is not going to be a rate cut. It is now currently expected to not have a rate cut at all. And that is not good for risk on assets. Risk on assets like cheap money and lower interest rates. This isn't great for risk on assets. This can be seen by the S&P 500 dropping by 1.3%. Again, these aren't really good things for the market. These aren't really good, strong indicators for growth in these risk on assets. And the S&P 500 is possibly the lowest of all risk on assets. But again, we have a few things that's coming in the future. Now, these are all great positive signs that the employment and unemployment and all these things are looking strong and buoyant. Now, the Fed, also that was seen in the minutes, are worried about Donald Trump's expenditure plans. These are all in line with what's happening in the market and how strong the economy is, points to a lack of a cut of an interest rate, which isn't fantastic, but now more clarity of where the market is. So there is this crazy balance that's happening right now with future potential expenditure by Donald Trump, fears of inflation, but a strong, buoyant market. We have to wait now until the 30th to see the CPI and growth numbers. And if they look good as well, I got a feeling that this lack of a rate cut is going to affect the market in any way whatsoever, because more strong things are being weighted on this side to point towards a buoyant market than not. The only issue we have as of yet is this 10-year bond yield. That is my only problem, because the higher that goes, the less people want to invest into risk on assets. We'll see. Let's see where this goes. But I will say one thing. I still think that especially things like Bitcoin and the alt season and all of those things may potentially rally off the back of this. We'll see. We'll see what happens. And I think the further we get towards the end of January and closer to this inauguration and closer to what is perceived to be an institution that is going to fuel money into the economy and actually cut regulation and be positive for crypto in general, may cause a relevant pump towards the end of the year. Let's see how the market reacts. But it's strange how good news can potentially mean a negative for risk on assets. Anyway, I'm Alvarez, a 7-figure crypto investor. Like, follow, share, and I will catch you guys later. Peace.